A pleasant day, everyone. For today's presentation, we will discuss about the consolidated statements of cash flow of Bloomberrry Resorts Corporation. Starting with the cash flows from operating activities. As what you can see on the table, the cash flow from operating activities of Bloomberrry Resorts Corporation increased by 10.9%, mainly because of increase in inventory, prepayments and other current assets, and decrease in the payables and other current liabilities. While in the cash flow from investing activities increased by 35.4 amounting to 5.4 billion pesos. On the other hand, the cash flow from financing activities decreased by 73.3%, mainly because of the increase in interest, long-term debt principal, and lease liabilities principal.
The company's current liability coverage ratio declined slightly from 0.89 in 2022 to 0.86 in 2023, indicating a marginal weakening in liquidity. This suggests a reduced ability to cover short-term liabilities with cash generated from operations. Although the decline is small, it may be a sign of early liquidity issues. If this trend continues, the company might face difficulties in meeting short-term financial obligations without relying on external financing or liquidating assets. Both ratios are below 1, meaning the company is not generating enough cash from operations to fully cover its current liabilities in both years. This suggests that the company is dependent on additional sources, such as financing or asset sales, to meet its short-term obligations. The company's operating cash coverage ratio increased slightly from 0.17 in 2022 to 0.18 in 2023, reflecting a small improvement in its ability to cover total liabilities with cash flow from operations. While the upward trend is positive, the ratio remains low, suggesting the company may still need to rely on external resources to meet its financial obligations. The improvement is encouraging, but continued efforts to boost operating cash flow or reduce liabilities are necessary for stronger long-term financial stability.
The price-to-cash flow ratio has slightly decreased from 5.74% in 2022 to 5.55% in 2023, indicating that investors are paying slightly less for the company's cash flow in 2023 than they were in 2022. This could signal a minor undervaluation or a shift in market sentiment. Despite the drop, the ratio remains moderate, suggesting the stock is not highly over or undervalued. The company appears to maintain a healthy cash flow, but the slight change in the ratio may warrant closer examination of stock performance or cash flow trend. The asset efficiency ratio decreased from 0.13% in 2022 to 0.12% in 2023, indicating a slight reduction in the company's ability to generate revenue or cash flow from its assets. This decline suggests that the company may be experiencing challenges in maximizing asset utilization or that its asset base has grown faster than its revenue or cash flow. While the decline is modest, it's essential to monitor this trend over time. Continued decreases could indicate worsening efficiency and may require strategic adjustments to improve asset utilization.
The external financing index ratio decreased significantly from 0.51 in 2022 to 0.12 in 2023, indicating a strong shift toward funding growth through internal resources rather than external financing. This change suggests improved financial stability and operational performance, but it may also limit growth potential if new opportunities arise. Monitoring this trend and comparing it to industry benchmarks will be important for understanding the company's financing strategies and growth trajectory.
The financial ratios for 2023
reflects a mixed performance compared to 2022. The current liability coverage ratio has slightly declined from 0.89 to 0.86, indicating a marginal decrease in liquidity and the ability to cover short-term obligations. However, the operating cash flow ratio has improved from 0.17 to 0.18, signaling better cash flow management. Additionally, the price-to-cash flow ratio has decreased, suggesting that the company's valuation relative to its cash flow is becoming more attractive to investors. 1. Improve liquidity and management. With the current liability coverage ratio slightly declining, it is crucial to focus on improving liquidity. This could involve optimizing working capital management. 2. Enhance asset utilization. The decrease in the asset efficiency ratio suggests that the company is generating less revenue per unit of asset. To address this, evaluate the performance of current assets and identify underperforming segments. Implementing strategies to improve operational efficiency and maximizing asset use. 3. Leverage reduce external financing. The significant drop in the external financing index indicates improved financial independence. To capitalize on this, continue focusing on internal financing sources and reinvest profits into the business for growth initiatives.